Matt, good to have you. Interesting point about Xilinx. Their prior revenue growth view was up 31. It's essentially doubled it. Is it that good of a fit?
Good morning, Carl. Thanks for having me. Yeah, I think it is. We've been a big proponent of the AMD Xilinx merger for a long time. It brings AMD into some diversified markets, auto, industrial, aerospace and defense, some non-consumer markets at really high 70% plus gross margins. And as Lisa mentioned in the spot that you just did there, because of some substrate supply investments that AMD's made, I think they can open up some new supply for Xilinx to grow into the demand they have. And ASP should be really good given the supply-demand gap out there. It's a great fit, and I think we'll be looking for them to talk more about integrating the two roadmaps together, particularly in the data center space going forward.
Right. It's been a series of lower highs and lower lows ever since 160 last Thanksgiving. Now we get more chatter about a cautious view on PCs, cautious view across the industry on gaming. How big of a threat is it?
Yeah, I think from my perspective, it was kind of the needle that they needed to thread last night on the call. You got big upside from the server business, the most important business at AMD, and a conservative view on PCs, which I think the market was pricing in anyway. Our team's modeling down mid-single digits for PC units. Lisa talked on the call last night about high single-digit assumptions in their model for the PC TAM, but the fact that due to share gains in enterprise notebook, and some shift from Chrome toward enterprise and the overall market mix, that they're still going to grow their PC revenue this year. That'll be a nice complement to a server business that's going to probably more than double. So it is a risk. I think investors have very much calculated that risk, especially with some of the demand destruction in Eastern Europe because of the war and some zero COVID shutdowns in China that have affected supply in the short term. Admitting to the risk and taking a conservative view is about as good as they could have done last night for AMD, and I think they'll still grow that business this year.
Now, Matt, so often these days we're talking about companies that are richly valued versus those that have high quality revenue and earnings. I mean, arguably, AMD still falls into both camps. I think that the PE, they're trading at around 21 times 2022 earnings and 18 times 2023. Is that okay in this market? Can you buy it at these levels that are so much lower than where it was before? So you might think of it as a discount, even though, you know, by historical measures, that's still kind of a rich valuation.
No, it's a great question, John. I think you can. Sub 20 times PE on $5 in earnings next year, give or take, is great value for AMD. If you think about where their most important business growth is in the server business, that's more than doubling, as I mentioned. You take profitability of that business. You mentioned strong profitability in the numbers here for AMD. We're looking at a server business that's going to double in revenue and have operating margins expand by 15 points. You're adding Xilinx that has extraordinarily healthy margins and much more broad exposure. And then you have the opportunity going forward for them to still enter new parts of the TAM. They're underrepresented in enterprise, both in PCs and server. They haven't yet got into the networking and telco space in the server market, which Xilinx can bring them into. And there's a lot of growth left here that the valuation, I don't think, represents as much as the stock has pulled back.
Matt, appreciate it. Always a fascinating print. There's a lot in there that speaks to the broader industry, too. We'll see you next time. Thanks.